So let me ask you a question. Are you the kind of investor who's always chasing the next big thing, the high-risk, high-reward play? Or do you play it a little safer, prioritizing security over those spectacular but maybe risky gains? It's one of the biggest questions in investing, and today, we're going to break it all down.
Okay, so to get our heads around this, let's look at two classic investor types. First, you've got the visionary. Think of the Elon Musk type, right? Someone who is willing to bet the entire farm on a massive, world-changing idea. And then on the other side, you've got the guardian, the investor who's all about safety, steady returns, and protecting what they have. And when I say bet the farm, I mean it. Just think about this for a second. After Elon Musk left PayPal, he took about $100 million and poured every last cent into SpaceX. This was a venture so ridiculously risky that the first 3 rocket launches were complete failures. The story goes that if that 4th launch had also failed, he would have been completely wiped out. That right there is the definition of a high-risk visionary. So just take a moment. Which one of those feels more like you? But here's the thing. This isn't just some personality quiz. What if I told you that we can actually turn that feeling into a hard number, a way to really understand the risk profile of your portfolio?
And that's where 2 simple Greek letters come into the picture, alpha and beta. These are incredibly powerful tools that let us measure the risk and the reward in any investment. They help us move away from vague feelings and into the world of actual data.
All right, let's kick things off with beta. Because really, before we can even start talking about rewards, we have to get a solid handle on the kind of risk we're taking to get them.
To put it simply, beta just tells you how much a stock's price tends to swing up and down compared to the overall market, like the S&P 500. It's a measure of that broad market risk. You know, the big stuff like interest rate changes or recessions that affect pretty much everyone. You can't just diversify this risk away. It's kind of like the baseline volatility you're signing up for.
The magic number here is 1. If a stock has a beta of exactly 1, it means it moves pretty much in lockstep with the market.
Now, if the beta is greater than 1, that stock is more volatile. It's going to amplify the market's swings, which means more risk, but also more potential reward.
And if the beta is less than 1, that stock is more stable. It's going to be a much smoother ride, especially when the market gets choppy. And this chart really brings the whole idea to life. So, a high-growth tech stock? It might have a beta of 1.5. An S&P 500 index fund, which is the market, has a beta of 1.0 by definition. And then you have a stable, predictable utility company, which might have a beta closer to 0.6. You can see the risk profile right there in the numbers. Our visionary investor might be drawn to that high beta tech stock, while our guardian would probably feel a lot more comfortable with that low beta utility. Okay, so now let's move on to alpha and see how it builds on what we know about risk. Because if beta is the risk you have to take just by being in the market, alpha is the reward you get for being smart. Alpha is the magic number. It's the extra return you get from investment after you've already accounted for its volatility, for its beta. In other words, it answers the question, did my investment do better or worse than I should have expected given the amount of risk I took on? A lot of people see it as the measure of a fund manager's actual skill.
A positive alpha. That's the goal. It means your investment gave you returns above and beyond what its risk level would normally suggest. This is exactly what active fund managers are paid to chase. It's the proof that they've actually added some real value.
A negative alpha, on the other hand. Ouch. That means for all the risk you took, you were actually under-rewarded compared to the market. You probably would have been better off just buying a simple index fund. And this is a brilliant way to see the basic idea. Let's just say the whole market went up 10% in a year. And let's assume your stock has a beta of 1, meaning it has average market risk. Well, you'd expect it to also go up about 10%. But what if your stock actually went up 13%? That extra 3% difference, that's your alpha. You generated 3 extra points of return for the risk you took. Not bad.
Okay, so here's the crucial part. It's how these 2 ideas, alpha and beta, come together. That's what paints the complete picture of any investment strategy.
What happens when we take risk, that's beta, and plot it on one axis, and then we take reward, that's alpha, and plot it on the other? Well, doing this lets us create a really powerful way to understand not just one stock, but your entire investment personality.
And what we get is this, the investor profile matrix. Check it out. Down here in the bottom left, we've got low alpha and low beta. That's low return for low risk. This is our safe and steady guardian. Then, all the way up in the top right, you have high alpha and high beta, high return for high risk, and that is our high-flying visionary.
So what's the sweet spot? Well, for a lot of investors, it's this top left box right here, high alpha and low beta. You can think of this as the holy grail of investing. You're getting market-beating returns, but you're not taking on a crazy amount of volatility to do it. It's really the best of both worlds.
So this is all great in theory, but how do you actually use this stuff? How do you apply it to your own investments?
Here's a super simple, actionable plan. First, just make a list of everything in your portfolio. Second, you can find the alpha and beta for your stocks on pretty much any major financial news site or through your broker. Just make sure you're looking at a consistent time frame like 1 year or 3 years. Third, once you have those numbers, you can calculate a weighted average to get a feel for your whole portfolio's character. And finally, you can see exactly where you land on that matrix we just looked at.
But at the end of the day, it's so important to remember this. The whole point of this isn't just about maximizing numbers on a screen. It's about making sure your investments line up with your own personal comfort level for risk so that you actually feel peaceful about your financial future, not stressed out.
And that really leaves us with the most important question of all. Forget the numbers for a minute and just ask yourself this. Right now, does your portfolio let you sleep peacefully at night? Because once you understand its alpha and beta, you won't just know the answer, you'll also know exactly why.